Hello, this is Will Allen with Sentara Capital. Today we are going to talk about how presidential elections impact the stock market. Now this is a perilous path to go down, talking about politics and investing, but spoiler alert, I am not going to be telling you how to vote. That said, there are trends that we can go over about how the stock market has performed in the past and what has happened to volatility during election years. And some of this may be a surprise to you. Let's dive into it. Every presidential election year, I hear from a couple clients on both sides of the aisle who ask me, hey, if my preferred candidate doesn't win, should I get out of the markets entirely? Well, the answer to that is no, and we're going to look into the data today to tell us why that is. The first chart we're going to show you takes a look at the S&P 500 going back to 1960 until 2024 here. And you can see in blue you have Democrats in the presidential, in the White House, and in red are when you have a Republican there. And you can see over time the stock market has gone much, much higher. And most of the time, no matter who's in the White House, the market goes higher. That's not always the case. One thing that I want to highlight is what's even more important in a lot of these cases, if you dig in and you study these terms, is were there any major macro events taking place at the time of the presidency? So for example, you could have the financial crisis or the COVID shutdown of the economy. Those a lot of times have a far more to do with portfolio performance and the markets than a president's policies per se. But again, when you take a look at that, what you will notice is that over time, you want to be invested because the markets go higher pretty much no matter who is president at that time. Now, something else we wanted to go over is the average volatility during an election year. And what you're looking at here is the VIX, which again, basically is a way to measure the amount of volatility happening in the stock market. What you will see there is that once you get into September, the volatility typically spikes and goes up and peaks normally in late October, early November, right before the election. What is normally happen that causes volatility to go up is that the stock market is going down. There's a sell-off because there is a lot of uncertainty at that time and a lot of investors get nervous. That, though, is typically a very good buying opportunity because you will notice that after the election, volatility tends to come back down to where it was pre-September. And this has been the case now the last 3 or 4 election cycles where the stock market did have a sell-off sometime in September, October that went up nicely after the election day. Now, nationwide, there are a lot of investors who move to cash in their portfolios during election years because they are worried about what the outcome may be. Our next chart takes a look at going back to 1950. If you got out of the market during election years, you have made 6.34% on an annual basis during that time. The S&P 500, if you stayed invested the whole time, has averaged a gain of 8.08% during that point. Now, let me give you some numbers to back up what a big difference this would be. If you took $10,000 at the start of this period and invested it, and you got out during election years and you made 6.34%, you would have $511,000 in the portfolio now. That's a nice gain. However, if you took that same $10,000 and didn't get out during election years and you earned 8.08% per year, you would have $1.44 million in the portfolio. That is a massive difference from $511,000. Our job is to help keep clients invested during presidential election years, and this is a good reason why. All right, the last data we're going to look at is specifically going back and looking at the 2016 election and the 2020 election because President Trump won in 2016, Biden won in 2020. In each case, the stock market rose following the election. If you take a look, you will notice in 2016, after President Trump won, in the 2 months after the election day, the markets was up over 6%. In 2020, when Biden won, the market was up over 14%. If we go out and look 1 year later, President Trump, the market went up 22% 1 year from the election. And for President Biden, it went up 34%. In both of those cases, there were concerns that the market was going to drop significantly, okay, by those on the political channels on cable TV. But as you can see, that was not the case. Now, I also want to look at the returns over Trump's term and over Biden's term so far, because in both cases, the markets have done well. Under President Trump, the S&P 500 was up over 80%, an average gain of over 16%. And under Biden, it was up 43%, an average gain of almost 12% per year. Those are both better than historical averages. Again, you also have to take into consideration what other things were happening in the world and the impact they had on the financial markets, not just on the policies. But it's important to note, if you had made the decision to get out of the market, if your candidate didn't win, it cost you dearly. Now, it is important for me to mention that there are differences, of course, in the presidential candidates' policies and what the impacts on the financial markets would be. Kamala Harris, on one hand, is in favor of raising the capital gain tax rate as well as the corporate tax rate, and that would not be very favorable to the financial markets. President Trump is in favor of raising tariffs, and that would not be very favorable to the financial markets. But if you listen to cable news or to the candidates themselves, every election they say, this is the most important election of our lifetimes, and if the other candidate wins, the apocalypse is going to be here. So it's understandable that that could be scary, or you could be nervous when you look at that. Our job, though, is to take a look at the data. We have a game plan for no matter what the outcome is at the president level, but also in the House of the Senate, and we are going to help guide our client portfolios regardless of the outcome. Take care. Thanks again for watching this video. Now, this is obviously a topic that a lot of people have a lot of questions about. So if you want to, go to the comment section, leave a question there, and we will get back to you. If you are new to Sentara Capital, you haven't seen our videos before, you can go to sentaracapital.com, go to the contact page, and reach out to us. We have a 3-meeting process to see if we are a good fit for each other. And if you are not getting this kind of information from your advisor, we would love to talk. Take care.